Good afternoon and welcome. You're tuned into Bulls, Bears, and the Bell, and thank you for joining us for this deep dive.
Great to be here. We're digging into the really turbulent market action from Friday, October 17th.
Yeah, our mission today is pretty straightforward. Cut through the noise, give you the essential insights from what was, frankly, a chaotic day.
It really was. We've got the comprehensive daily market data and outlook briefing right here, focusing on that session. And if you were watching, it wasn't smooth sailing.
Not at all. It felt like a constant, violent tug of war. On one side, you had these really acute fears about regional bank contagion, the kind of thing that makes money just vanish from a sector.
But then pushing back hard, you had these surprisingly strong earnings reports coming in, kind of a firewall.
A sudden shift in geopolitical talk, specifically U.S.-China trade, coming straight from the top.
Exactly. And that tension, that push and pull, it created this wild intraday reversal. But the end result, the market felt like it was, perched on a knife's edge.
Right. So despite some headline indices looking okay, maybe even up a bit, the internal picture, well, that's what we need to unpack. The data suggests the market actually finished weaker, more fragile.
Yeah, much more fragile than where it started.
Okay, let's really get into this because that one day, Friday, it was like a perfect miniature version of all the big conflicts playing out. Fear versus confidence, tick by tick. We need to trace how that unfolded.
So first off, you got to understand the mood heading into Friday. Thursday had ended with a pretty sharp sell-off.
Driven by those first whispers about the banks, right?
Exactly. So that negative feeling, that anxiety, it was already completely baked into the system before Friday trading even began.
Yeah.
Deeply negative sentiment carrying over.
That's critical context because before 9:30 a.m. Eastern, the signals were all flashing red. Futures for the S&P 500, the NASDAQ 100, both down, over 1%?
Yeah, easily over 1%. And Dow futures, representing those big industrial names, they were down around 350 points. That signals major risk aversion. Big players were getting ready to sell.
And sure enough, that fear showed up right at the opening bell. S&P started down about 0.25%. NASDAQ maybe closer to 0.5% down.
The price action just screamed, we're bracing for more bad news, especially on the credit front. Investors were definitely assuming the worst was yet to come.
But here's where it gets really telling about the market's instability. The way it closed, the major indices ended up telling completely different stories. No unity at all.
That's what's so fascinating, that headline divergence. It just proves the rally that happened midday was incredibly narrow. It wasn't broad-based confidence returning.
So give us the numbers. Who actually won the day?
Although the Dow Jones Industrial Average was, you could say, the only clear winner. It managed to climb about 203 points, closing at 46,270, probably helped by its defensive, value stock makeup.
At tech. The growth engine.
Suffered. The NASDAQ composite took a material hit, down about 173 points, closing way lower at 22,521, a really significant drop.
And the S&P 500, the broad market measure.
Basically flat, maybe slightly down, closing at 6,644. So you see the split. Dow up, NASDAQ down hard, S&P treading water.
Yeah, that's not a picture of health. A real recovery needs everyone participating, right?
Especially tech.
Absolutely. When tech, the sector representing future growth, is getting hammered while a defensive index like the Dow ekes out a gain, that tells you money is running from risk, not towards it. It's looking for stability, not betting on growth.
Like retreating to the bunker instead of charging back onto the field.
Yeah.
Okay, so tracing the day. We start with that pre-market panic, nervous open, hit a low.
Then bang, midday, a sharp reversal kicks in. And that was triggered by two key things we need to dig into. Those strong bank earnings and that unexpected trade talk.
But that recovery didn't stick, did it?
Nope. The conviction just evaporated later in the day. You saw this late day fade, especially hitting those high-flying tech stocks again. The morning relief rally just couldn't overcome the deeper anxiety. So that failure to hold the gains, especially in the broader market, even as the Dow held up, that's the real psychological takeaway from Friday's action. Fragility. All right, let's pinpoint the source of that anxiety spike. This wasn't some slow burn systemic rot. It was like a lightning strike late Thursday. Specific news that just instantly brought back all those bad memories from the 2023 regional banking mess.
That's right. This was the contagion catalyst. The fear sparked when two specific regional lenders revealed they had big problems with some loans, charge-offs, and crucially, linked them to potential fraud.
Fraud, that's the key word, isn't it? It's not just bad loans. It's something potentially much worse.
Exactly. The word fraud implies control failures, maybe even criminality. That's what triggers indiscriminate panic selling, much more than just, say, a slowing economy causing defaults.
Okay, let's name names for our learners. Zion's Bank Corporation, ZION. Their stock got crushed, right? Down a massive 13% in one day.
13%, which is just enormous for a bank. And get this, it happened even though their actual earnings report beat the analysts' forecasts.
So the core business was doing okay, but something else spooked the market.
Precisely. It wasn't the profit numbers. It was a separate regulatory filing. That filing revealed a $50 million charge-off tied to about $60 million in syndicated loans. And it specifically mentioned potential fraud related to those loans.
50 million might not sound huge for a bank, but the fraud element changes everything.
It suggests maybe their risk management, their internal controls weren't up to scratch. That's far scarier for investors than just a few loans going bad because the economy slowed down.
And it wasn't just Zion's. Western Alliance, Wolf UL, got dragged down too.
Yup, fell nearly 11% on very similar credit quality concerns, possibly related. The market reaction was immediate and brutal. It's that classic first cockroach fear.
The Jamie Dimon saying, you see one problem.
And you assume there are 10 more hiding in the walls.
Exactly.
So investors didn't wait to ask questions. They just sold the entire sector. Indiscriminate selling.
Which explains the drop in the regional banking ETF, KRE.
Dropped 6% just on Thursday. Investors basically fled the whole group, pouring money into safer havens, into cash, whatever felt secure. Pure risk aversion.
Okay, hold on. If the panic was that bad, that indiscriminate, how did things stabilize on Friday? Why didn't the whole sector just collapse? Does Zion's falling 13% mean the system is genuinely broken?
That's where the story takes a turn. Friday morning brought the earnings counterpoint. That acted as a crucial firewall.
Meaning
When some of the other big financial players started reporting their results on Friday, the news was actually pretty good, really good in some cases. It countered that narrative of widespread doom. It showed the problem might be isolated, not systemic.
Okay, like who? Give us an example.
American Express, XSP. Their stock climbed over 6%. Why? Because they absolutely crushed expectations. Q3 earnings per share were $4.14, way above the $3.99 forecast. Revenue was strong too.
And what drove that strength for Amex?
Get this. Management pointed specifically to a massive 9% jump in spending by their affluent customers. The high-end consumer was still spending strong.
Wow, okay. That's a powerful signal about the economy's resilience, at least at the top end.
And they didn't stop there. They actually raised the lower end of their full-year profit guidance. That kind of confidence, especially about consumer health among wealthier folks who are less sensitive to rates, that provided immediate, tangible relief to the market.
And Amex wasn't the only one providing reassurance.
No, exactly. Other names that had been under pressure, like Ally Financial, Fifth Third Bancorp, Regions Financial, they also came out and topped their earnings estimates.
So real data was coming in saying, hey, maybe this isn't everywhere.
Precisely. It provided concrete evidence that the systemic risk everyone freaked out about on Thursday maybe wasn't materializing. The crisis looked more contained, more localized to those specific lenders like Zion's and Western Alliance, not a sector-wide meltdown.
Did Wall Street analysts jump in to calm things down?
Oh, absolutely. Swiftly. You saw immediate analyst intervention. Baird, for instance. They actually upgraded Zion, to outperform.
Wait, they upgraded the stock that just fell 13% because of fraud concerns.
They did. Their argument was basically that the market reaction was way overdone, wiping out over $1 billion in market value because of a manageable $50 million charge-off, even with the fraud element. They argued it was a severe overreaction.
So separating the specific bad news from a systemic threat.
Exactly, making that crucial distinction. And other analysts like James Riley at Capital Economics echoed this, telling clients, look, the backdrop today is very different from past financial crises. These jitters shouldn't derail the whole market for long.
Okay, here's where I think it gets really interesting, thinking longer term. The market reacted by basically saying, okay, Amex with its fortress balance sheet is fine, but Zion's, this regional lender, has a problem. This creates a kind of two-tiered system in banking, right? What's the strategic implication here?
That is absolutely the key takeaway long term. That two-tier narrative is now deeply embedded in how markets view banks. What happened last week basically trained investors, and probably regulators too, to apply a much higher risk premium almost permanently to regional banks, especially those without really diverse loan books or strong non-interest income streams, like fees.
So the smaller guys can't borrow as cheaply or easily as the huge global banks anymore.
Correct. Their cost to capital goes up. They're seen as inherently riskier now, post-2023 and post this latest scare.
Okay, but why should, say, a small business owner or just the average person care about the borrowing costs of a regional bank? How does that separation actually impact Main Street?
Ah, that's the critical link. That higher risk premium, that higher cost of capital for regional banks, it translates directly into tighter lending standards and higher loan rates from those banks. They have to pass on their increased costs and perceived risk.
And regional banks are the ones lending to most small businesses.
Exactly. The vast majority of local businesses, your corner store, your local manufacturer, they don't get loans from JP Morgan. They borrow from their community or regional bank. So when those banks tighten up,
It creates a credit crunch, but localized.
precisely, that's the long-term impact. The immediate crisis might feel contained on Wall Street, but the restrictive consequences are just starting. It acts as this subtle, persistent drag on small business investment, on local economic activity, and ultimately on broader U.S. growth over the coming months, maybe quarters. Wall Street might have dodged a bullet, but Main Street might feel a squeeze. So while the banks gave us the initial shock and then some, contained relief, that big midday turnaround on Friday, it wouldn't have happened, or at least not held up as well, without some action from Washington.
Right, which brings us to the second major force moving markets that day, political headlines. And it was a real mixed bag, wasn't it? Both positive and negative shocks.
Definitely. First, let's talk about the positive pivot. This acted almost like a temporary Trump put, a signal that maybe things wouldn't get worse on the trade front.
What was the specific news?
It was President Trump himself delivering a surprisingly conciliatory message about U.S.-China trade. He essentially walked back some of his own previous very aggressive threats. Specifically, he called the idea of slapping 100% tariffs on all Chinese goods not sustainable.
Wow, okay, walking back a 100% tariff threat is significant. How did the market react to that?
Instantly and positively. That softer rhetoric was exactly what Wall Street had been desperate to hear. It provided this immediate temporary floor under the market, especially for companies with global exposure. It eased those trade war anxieties that had been simmering again.
So the market's relief rally got a major boost from that. It shows how sensitive traders still are to that relationship.
Absolutely. That powerful positive reaction just demonstrates the underlying hunger for stability, for reduced trade tensions. Any sign of de-escalation gets bought, basically. It shows how much volatility is still priced into that U.S.-China dynamic.
But as you said, it was a mixed bag from Washington. Politics didn't just offer relief, it also dealt a direct blow to one specific sector. The negative side of the coin.
Right. Regulatory risk hit the pharmaceutical sector hard.
How so?
This was focused on that very popular, very profitable new class of drugs, the GLP-1 weight loss medications. Think Ozempic, Wegovy, Mounjaro, huge revenue drivers. President Trump publicly promised he would seek much lower prices for these drugs, presumably through government action or negotiation.
Ouch. Threatening the pricing power of blockbuster drugs. What happened then?
Immediate impact. Eli Lilly, LLY, which is a giant in this space, saw its stock drop almost 4% just in pre-market trading on that news alone.
Just based on a statement, a promise.
Exactly. It perfectly highlights that acute headline risk in healthcare. Billions in market value can just evaporate instantly based on a politician's comment about potential future regulations. It's a huge risk factor for that sector. And, we have to place these specific comments, both trade and pharma, within the wider geopolitical backdrop. Because while the trade talk was softer that day, the underlying strategic competition, it's still escalating.
Right. It's not like everything's suddenly friendly. China's still doing things like imposing new export controls on certain material.
And the U.S. is responding in kind. For example, banning dealings with several subsidiaries of Hanwha Ocean, the big South Korean shipbuilder. That's part of a push to try and rebuild America's own industrial base, but it creates friction.
It's this constant tit-for-tat that keeps things tense and unpredictable.
And it has real costs. You can see it reflected in weird places, like the dry bulk shipping index, basically, the cost of moving raw materials around the world. That jumped almost 7% in just 1 week. Geopolitical tension isn't just talk. It drives up global costs, logistics costs, commodity costs, which ultimately feeds back into inflation risk down the road.
And finally, we can't talk about Washington without mentioning the ongoing headwind, the federal government shutdown, now into its third week by that point.
Yeah, and from a market perspective, the biggest problem with the shutdown is the information vacuum it creates.
Because key economic data isn't getting released.
Exactly. We're flying blind. We're missing timely updates on inflation, on retail sales, on jobs. all the stuff the Federal Reserve normally uses to make decisions.
Which makes the Fed's job incredibly difficult. They're relying on market signals, maybe lagging data.
It complicates their role immeasurably, and it makes that policy trap we're going to discuss next even more dangerous. They're trying to navigate a storm without their usual instruments. Okay, so let's pull it all together on the market action itself. Even though the Dow managed to close higher on Friday, when you dig into the underlying data, the analysis is pretty clear. That recovery, it was narrow, it felt technical, and it was built on a really weak foundation.
And the main proof of that weakness is market breadth, right? This tells us how many stocks are actually participating in a move.
Exactly. Market breadth is probably the most critical, vital sign for the health of any rally. If only a handful of big stocks are lifting the index while most others are falling or flat, that rally is fragile. It's not sustainable.
So what did the breadth numbers look like after Friday's close?
Not good. As of the close, just under 40%. Less than 4 out of 10 S&P 500 stocks were trading above their 50-day moving average.
Wow, under 40%. And how does that compare to recently?
That's down sharply. Just a month earlier, in September, that number was over 60%. So a significant deterioration.
That's a huge negative divergence. The main index might look okay or even up like the Dow, but most of the soldiers in the army are actually falling back.
That's a great analogy. It's high concentration risk, and historically, that is absolutely not a good sign for the bulls. It suggests the gains lack broad support.
Okay, what about fear levels? Did the VIX, the fear gauge, reflect that fragility?
Well, yes and no. The VIX did fall on Friday, down about 6.4% to close around 23.68.
So less panic than Thursday.
Right. The acute panic from the bank scare definitely subsided a bit. But, and this is a big but, 23.68 is still very elevated. Think of it this way. A truly calm market usually has a VIX below 20. We're still well above that.
So maybe not gale force winds, but still very choppy seas.
Exactly. That level is still near a 5-month high. It tells you investors are still bracing for significant volatility ahead. They're buying protection. The fear hasn't gone away. It just stepped back slightly from the immediate cliff edge.
And what was happening specifically within the tech sector? Because the Nasdaq's decline suggests something wasn't right there.
Yeah, there was clear evidence of institutional selling in key tech names. You saw high trading volume accompanying falling prices. That often indicates that the big money managers, the sophisticated investors, are actively distributing shares, basically, selling off their positions.
Any specific examples stand out?
NVIDIA, the AI darling, it slipped about 0.75% during the main session, which maybe doesn't sound like much.
Yeah.
But then look at the after-hours trading.
What happened there?
It was the most actively traded stock after the bell, and it fell another 2.3% on really heavy volume.
Heavy volume selling after hours. That's usually institutions, right?
Often, yes.
Yeah.
And that selling pushed NVIDIA's stock right down to test a critical support level, an upward trend line around $180 that had held since early September.
So professionals might be betting that support level breaks, selling ahead of a potential bigger drop.
That's certainly what the pattern suggests. Heavy institutional distribution near a key support level. It makes you question the sustainability of that whole AI-driven rally, at least in terms of valuation. It smells like preparation for a potential breakdown.
Did we see similar skepticism elsewhere in tech?
We did. Look at Oracle, ORCL. The stock fell quite a bit, even though the company shared some positive news about its AI cloud business. They mentioned strong gross margins like 35% over the life of a contract.
Good margins, but the stock still falls. Why?
It seems to reflect this deeper market skepticism about Oracle's ability to really compete long-term against...
Okay, so if market breadth was poor, fear was still high, and big tech stocks were seeing institutional selling, what actually caused the market to bounce off its lows midday Friday, if it wasn't real conviction?
We have to conclude the main driver was purely technical. It was a classic short squeeze.
Explain that simply.
Okay, so after Thursday's panic, tons of traders were betting against the banks. They shorted the stocks, meaning they borrowed shares and sold them, hoping to buy them back cheaper when the price fell further.
They were positioned for more downside.
Exactly. Overwhelmingly so. Then, Friday morning, you get unexpectedly good news from companies like American Express. Suddenly, those short sellers are trapped. The price is going up, not down.
So they have to buy back the shares quickly to cut their losses.
Precisely. They're forced to cover their shorts. And that forced buying creates this artificial surge in demand for those specific stocks, causing an outsized spike in their prices.
So the rally wasn't investors suddenly feeling confident about the economy. It was short sellers scrambling to avoid bigger losses.
That's the most plausible explanation for the intensity of the bounce in certain names. It was a massive technical repositioning event. The short-term pain of being caught short temporarily overshadowed the deeper macro fear. But that underlying fear, it didn't go away, as shown by gold's strength and the continued weakness in those growth-sensitive tech stocks.
Okay, this brings us to what I think is maybe the weirdest, most paradoxical situation in the market right now. I'm calling it the Great Disconnect. We're seeing a powerful rally happening at the same time in two assets that should theoretically hate each other, gold and the Nasdaq.
It is truly bizarre. Let's break it down.
Sure.
Gold. It's the ultimate fear gauge, right? The safe haven you run to when you think the world might be ending, financially or geopolitically.
And what's gold been doing?
Surging. On that Friday, October 17th, it hit a new record high, breaking above $4,300 an ounce. Year to date, it was up almost 60%. That's best performance since, 1979. That screams deep, deep macroeconomic fear.
Okay, so gold is signaling risk off, but the Nasdaq, that's home to speculative tech stocks, growth dreams. Usually the first thing people sell when they're scared.
Exactly. They should move in opposite directions. Money flowing into gold usually means money is flowing out of the Nasdaq. Inverse correlation, normally.
That's not what's happening now.
Not at all. And this is where it gets statistically nuts if we connect this to the bigger picture. Over the last 90 trading days leading up to that point, the statistical correlation between the Nasdaq 100 index and the price of gold, it surged to an unprecedented positive 0.78.
Positive 0.78, meaning they're moving almost in lockstep. Up together, down together.
Pretty much. Which historically makes absolutely no sense. It's a mathematical anomaly.
How is that even possible? What does it signify?
It suggests the market is being ripped in two opposing directions simultaneously. On one hand, you have profound macroeconomic and geopolitical fear driving capital into gold. On the other hand, you have this incredibly powerful, maybe speculative wave of enthusiasm about artificial intelligence fueling the Nasdaq.
Fear and greed on steroids, both at the same time.
Kind of. It's like investors are suffering from profound cognitive dissonance. And history tells us this kind of extreme positive correlation between fundamentally opposing assets is totally unsustainable.
Meaning something has to give.
Absolutely.
Yes.
One side of this trade has to break. Either the deep economic fear will overwhelm the AI hype, causing tech to crash, or the optimism about future growth will somehow conquer the fear, potentially leading to a pullback in gold. But they likely can't both keep climbing together like this indefinitely. A major correction in one or the other seems almost inevitable.
And this underlying fear, the one driving gold, is also feeding expectations about the Fed, right? People are now betting heavily on rate cuts.
Oh, completely. Dovish Fed expectations have solidified. The market is pricing in rate cuts with almost total certainty now. That's driven partly by the banking stress we talked about, the idea the Fed might need to ease financial conditions.
And Fed officials themselves have sounded a bit more cautious.
Yeah, comments from people like Fed Governor Waller talking about supporting a potentially weaker labor market. The market reads that as dovish, as opening the door to cuts.
How certain is the market about cuts?
Look at the CME FedWatch tool. Based on futures trading, it was implying a 100% probability, 100%, of at least a 25 basis point rate cut at the very next Fed meeting in October.
Wow. Not even a question in the market's mind.
And looking further out, traders were pricing in about 53 basis points of total cuts by the end of the year. That expectation had actually increased recently, up from maybe 46 basis points just a bit earlier. The market is leaning hard into the easing narrative.
And we're seeing the impact in bonds and the dollar.
Definitely. The 10-year Treasury yield, a key benchmark, dipped below that psychologically important 4% level, down to 3.99%. Lower yields reflect rate cut expectations.
And the dollar.
The Bloomberg Dollar Spot Index was on track for its worst week since July. If the Fed starts cutting rates aggressively, the U.S. loses some of that yield advantage compared to other countries, making the dollar less attractive. Investors are anticipating that.
Okay, so the market is screaming for rate cuts, driven by fear. But this puts the Federal Reserve in an incredibly difficult position, doesn't it? Especially with the government shutdown. This is the policy trap.
It's a treacherous spot. They're essentially blinded. The shutdown means they aren't getting the timely inflation data, the jobs data, the retail sales data they need to make informed decisions.
So they're forced to rely more on, what, market signals, like the banking turmoil?
Exactly. They're having to read the tea leaves of market volatility and fear. And the market itself, through falling yields and these rising rate cut expectations, is effectively creating its own unplanned monetary easing. The market is basically telling the Fed, you need to cut rates because we're scared. not necessarily because the official economic data clearly shows a need for it.
But isn't there a huge risk in cutting rates just because the market is scared? What about inflation? Didn't they just spend 2 years fighting that?
That is the absolute core of the trap. It sets up a profound risk of a major policy error. Scenario 1. The Fed caves to market pressure, cuts rates aggressively to calm the banking fears and prevent a potential credit crunch. The risk, they reignite underlying inflation, which organizations like the IMF were still warning was above target. They could undo all their hard work and lose credibility.
Okay, what's scenario 2?
Scenario 2. The Fed ignores the market noise, stays focused purely on the inflation mandate, and keeps rates high or doesn't cut as much as expected. The risk there, they could worsen the banking sector's confidence crisis, maybe tip some weaker players over the edge, and actually trigger a more severe credit crunch themselves.
Damned if they do, damned if they don't.
Pretty much. They're caught between fighting inflation and ensuring financial stability, and they have to make that choice without their usual full set of data. The odds of making a mistake, a costly misstep with big economic consequences, are significantly higher right now than they've been in a long time. Okay, so looking ahead, this coming week is going to be absolutely critical. It's a major testing ground for market resilience, especially as we get deeper into this rather nuanced earnings season.
Nuanced, how so? Because on the surface, the numbers look pretty good, right? Something like 86% of companies beating estimates.
Yeah, the headline beat rate is impressive. 86.2% of the S&P 500 companies that had reported by then had beaten Wall Street's earnings estimates. That's way better than the long-term average, which is around 67%. So yes, companies are clearing the bar.
But
There's always a but.
the but is how high the bar was set. Many analysts argue companies are clearing a significantly lowered bar. Expectations were managed down quite a bit heading into the season.
And the proof is in the margin of the beat. Exactly. The crucial metric isn't just if they beat, but by how much. And the average beat margin so far was only 5.9% above estimates.
Okay, 5.9%. Is that good or bad?
It's actually below average. The 5-year average beat margin is higher, around 8.4%, and the 10-year average is also higher. It's 7.0%.
Ah, okay. So companies are doing better than expected, but not as much better as they usually do. The power to positively surprise the market is maybe fading a bit.
That's the implication. Profits are proving resilient, which is good, but they might not have the same power to really drive the market significantly higher if the upside surprises are getting smaller.
Got it. So the week ahead is a big test because a lot more companies are reporting.
It's a huge wave.
Yeah.
Around 89 S&P 500 companies are on the docket. We really need to watch the big names on the upcoming earnings radar because their results and, maybe more importantly, their outlooks could set the market's tone.
Okay, who are the key ones to watch? Tuesday.
Tuesday, October 21st. It's all about Netflix, NFLX. Investors are laser-focused on subscriber growth, obviously, but also critically, how well that new ad-supported streaming tier is doing. Is it bringing in new users? Is it making money? That's the key to their future growth story.
Wednesday looks dizzy too.
Big day Wednesday. First, Tesla, TSLA. The market will be dissecting their automotive gross margins, excluding those volatile regulatory credits. We need the real picture of their manufacturing profitability. Plus, any updates on the Cybertruck production ramp, and crucially, what they say about demand in this high interest rate environment. Can people still afford Teslas?
And who else reports Wednesday?
IBM. Big Blue. Their report is always a good gauge of corporate IT spending. We'll be looking for insights into consulting demand and just general enterprise spending trends. Are big companies still investing confidently in technology? IBM gives us clues.
And Thursday.
Thursday brings Intel, INTC. Really important report for them. Everyone wants to know about their progress in becoming a major chip manufacturer for other companies, their foundry services strategy, and of course how their own AI chip strategy is shaping up against the leaders, NVIDIA and AMD. It's a critical turnaround story for Intel.
Okay, so lots of corporate tests. What about the economic data front? Anything important coming out globally?
Yes, definitely. The economic data dashboard next week is crucial because we'll get the first real look at Q3 economic activity from some major economies outside the U.S., which has been delayed by the shutdown.
That's the biggest one.
Probably Monday, October 20th. China releases its Q3 GDP growth year over year. The consensus forecast was for 4.8% growth. That's already a slowdown from 5.2% the previous quarter.
And if China's number misses that 4.8% consensus?
A significant miss to the downside would be a major red flag for global growth overall. China is such a huge engine of demand. A weaker China could put immediate downward pressure on commodity prices and hit the stocks of any multinational companies that sell a lot there. It's a key global barometer.
Any other key data points? Inflation, maybe?
Yeah, inflation is still front and center.
Yeah.
Tuesday, we get Canada's latest inflation rate. Wednesday brings the UK's inflation rate. These are super important inputs for the Bank of Canada and the Bank of England as they decide on their next interest rate moves. Those reports will definitely move currencies.
And back in the U.S., even with the shutdown delays.
We do get U.S. existing home sales on Thursday. It's maybe not the timeliest indicator, but it still gives us a useful read on the health of the housing market and maybe broader consumer confidence. Are people willing or able to make huge purchases like a house in this kind of environment? Hashtag tag tag outro out.
Okay, so let's try and synthesize all of this. What does it all mean for you, the listener, trying to make sense of this volatile market? The bottom line seems pretty clear. The market isn't really recovered. It's still in a state of profound conflict.
Fragile.
Absolutely fragile. That fragility comes from this huge, seemingly irreconcilable gap. On one side, you have surprisingly resilient company earnings. At the micro-level, businesses finding ways to adapt and beat lowered expectations.
On the other side.
A rapidly deteriorating macro environment. Fear is dominant, driven by those banking stresses we talked about, ongoing geopolitical risks, and the uncertainty around Fed policy. Micro-resilience versus macro fear.
So from a strategic perspective, what's the takeaway? Still cautious.
I think a cautious defensive posture still makes the most sense. Look, the Dow's outperformance on Friday, that's a classic sign of rotation into value and defensive sectors. It happens when investors are getting more risk-averse, not less.
And gold hitting record highs basically confirms it. The dominant underlying trend is still risk aversion. Friday's bounce felt technical, it felt headline-driven, maybe a short squeeze. It didn't feel like a fundamental solution to the big problems we've analyzed today.
Okay, so let's quickly recap the key risks people need to keep monitoring right now. The big three.
Number 1, credit contagion. The risk that more bad news pops up from another regional bank, reigniting that panic from Thursday and maybe starting that localized credit crunch we discussed, that's still very much a live risk.
Number 2.
Policy error. The Fed is flying blind because of the shutdown, stuck in that trap. Will they cut too soon and reignite inflation, or stay too tight and cause a deeper crunch? The chance of a misstep is high.
And number 3.
Geopolitical escalation, especially U.S.-China. Friday's softer rhetoric was nice, but it could reverse on a dime. Any new tariffs, sanctions, or harsh words could instantly kill the market's fragile mood.
All right. And let's leave our listeners with that final provocative thought, building on that weird gold-NASDAQ relationship.
Right. That extremely high positive 0.78 correlation between gold, representing deep fear, and the NASDAQ, representing speculative tech enthusiasm. It's just not sustainable mathematically or fundamentally over the long run.
So the question for you to ponder is,
which force do you ultimately believe is stronger right now? Is it the deep economic fear driven by potential credit issues, geopolitics, and policy uncertainty? Or is it the high-tech speculative fever driven by the transformative promise of AI?
because one of those narratives, one side of that massive trade, eventually has to break. And figuring out which one will dictate the next major market move.
That's the billion-dollar question, isn't it? Where capital flows next depends on the answer.
Indeed it does. Well, thank you for joining us for this deep dive into the really complex market dynamics of mid-October 2025. We'll keep tracking all these developments.